This is Economy Watch, what you need to know about New Zealand's economic life today. Brought to you by interest.co.nz.
Kia ora and welcome to interest.co.nz. I'm Gareth Vaughan. Let's talk about house prices. Yes, I thought that'd grab your attention. House prices continue to defy gravity and seem to be one of the few things immune to COVID-19. New Zealand's median house price rose 26% in the August year, reaching $850,000. This median house price is equivalent to an eye-watering 8.7 times the median household income. Meanwhile, the average mortgage size rose 34% in the June year, and as of June, there were nearly 25,000 applicants on the social housing waiting list. All this means it's getting harder for people who don't already own a home to get one. Taking a step back, home ownership is typically regarded as a good thing. Why is this? We asked Arthur Grimes. He's a former Reserve Bank chairman and chief economist who now heads up wellbeing and public policy at Victoria University and is also a senior fellow at Motu Economic and Public Policy Research.
It's particularly important for a country such as New Zealand where we don't have long-term tenancies, except in the social housing sector, and for families with children. So families with children who are in short-term tenancies frequently can have those tenancies terminated for all sorts of reasons. The landlord might want to sell up or move back in or move their family in or whatever. And then, of course, those families with children have to move on. This leads to, obviously, dislocation within the family, but it also may mean that children move schools and lose schoolings. They lose their what they've learnt in the last few months at school. So we see a lot of negative effects on children of moving frequently. Home ownership can clearly alleviate that, provided the home ownership is affordable. And that's really the big issue in New Zealand now, is that for many families, home ownership is not affordable.
So do house prices simply have to keep rising, making it harder for low-income earners and young people who don't have wealthy parents to own their own homes? Unlike some other countries, New Zealand hasn't had a major fall in house prices in decades. But could a fall actually be helpful for the greater good? Our most powerful politicians certainly don't think so. When he was Prime Minister, John Key said Auckland's high house prices were a quality problem and a sign of success. And Jacinda Ardern has said homeowners expect to see the value of their biggest asset rise. This is her speaking last December.
Look, what we've simply expressed here is that the growth that we're seeing is just unsustainable. And so if anything, look, it is much more sustainable to have those much smaller increases. I think people expect that you see that in the market. What we also accept is that for most New Zealanders, their house is their most significant asset. So if you see, for instance, as was predicted at the beginning of the year, a significant crash in the housing market, that impacts, of course, people's most significant asset.
But where will New Zealand end up if prices keep rising, even at a slower rate? For the purpose of this podcast, we're going to transport you to a fictional world where Aotearoa New Zealand has a government that does want house prices to fall. 4 key questions we're looking to address are: would it be possible to engineer a housing market correction? Would it be desirable to do so? Could a housing market correction be controlled? And could we protect those who would be hardest hit by a correction? Let's begin by looking at whether it would be possible to engineer a housing market correction. Here's Arthur.
Certainly would be possible. We've engineered a house price explosion, so there's no reason why we can't do the opposite and engineer a house price correction. We've had both tax policies and monetary policy, as well as regulatory policies leading to house price rises, and most recently it's been monetary policy that's been the main cause. Before that it was probably regulatory policies and tax policies. So if we addressed each of those 3 areas, we could significantly reduce house prices in New Zealand.
So what's the problem with monetary policy, or the way the Reserve Bank changes interest rates to meet its inflation and employment targets?
Well, unfortunately, when this government came in about 2018, they changed the Reserve Bank Act from one where the central bank, the Reserve Bank of New Zealand, was targeting price stability, to a situation where they were targeting both price stability and maximum sustainable employment. Now, when a central bank has that second leg to the mandate, it means that they almost invariably don't tolerate any reduction in house prices because that might lead to some bankruptcies, it might lead to some unemployment, etc. So they deliberately engineer credit conditions to keep house prices up. People know that they're going to do that, and therefore it's essentially a one-way bet on house prices. And so this one-way bet on house prices means people get in, the fear of missing out mentality.
Arthur reckons removing that employment target could enable the Reserve Bank to lift interest rates, which would deter people from borrowing. Arthur also wants the Reserve Bank's inflation target to be tweaked, so it's made to target house price inflation as well as consumer inflation. Because there's a lot of house price inflation, this would prompt the Reserve Bank to lift interest rates. But what about the tax system?
Well, we've moved in the right directions, I think. It was very sad under the last tax working group that the government ruled out a capital gains tax, but then they sort of brought one in by extending the bright line test, etc. It doesn't affect capital gains on the owner-occupied house, and also what it doesn't tax is the what we call the imputed rent on a house. That if I buy a house, I'm essentially giving myself free rent, and that is like an income source for me. In some countries, that imputed rent is taxed. It is in a number of countries in Europe, and most tax experts would say it should be taxed. And no government in New Zealand has ventured to looking at the kind of taxes in that route that would be normal in some countries in Europe.
So wouldn't simply boosting housing supply by building more houses help?
Ideally, yes. The problem with that sort of side of things is it takes a long time to get underway. We're already short of builders, we're probably short of building materials, we're short of developed sections, etc., short of infrastructure. So we've been restricting the supply side for 20 or 30 years now through various council and central government regulations, and it's going to take easily a decade or so to really fix those sorts of problems. So it's not a short-term fix, but it's absolutely crucial for the long term.
Okay, so it sounds like a government with the desire to reduce house prices could do it. But what impact would doing so have on financial stability or the banking system? Could banks cope? David Cunningham was until recently the chief executive of the Cooperative Bank and is also a former executive at Westpac. He reckons banks could cope.
So from a bank's perspective, if it's sort of unwinding a rapid price increase that happened very recently, it's not such a big deal, but it's when it starts to bite into people that have bought over, say, 1, 2, 3 years that it really starts to sort of bite. But that said, the issue is twofold, really, from a bank's perspective. One is do people keep paying their mortgages? Because the key thing about banking is that it's a delinquency managed. There's all delinquency managed portfolios, which means that so long as you keep making the relevant payments that you're contracted to make, the bank doesn't look at your financial circumstance and so, you could be out of work for a while or have built up a buffer so you're able to keep making payments at the time. So the fact that the portfolios are delinquency managed creates this sort of buffer effect that until people stop paying, then the banks are happy. But that's sort of one sort of insight. The second one is banks, the last thing they want to do is create the situation where they're forcing people to sell properties and so on. And that we saw that post-GFC where prices did fall somewhat, unemployment went up, which is the reason that delinquency management thing is not such a big deal, because unless unemployment really rises massively, you've got people unable to pay their debt, then they don't get into that situation of being potentially forced to sell up. But reputationally, banks hate that sort of stuff and in terms of selling people up. And so post-GFC, all the banks had teams set up to help customers get through those situations and find every which way possible so the customer didn't have to sell their house. So, two key sort of impacts that make it in the interest of banks not to, firstly, I guess, see that situation arise, but actually making that situation arising way less likely anyway, unless you have a very, very high increase in unemployment.
Last year, the Reserve Bank released details of stress tests it did on banks. These showed even if house prices fell 37%, bank capital, or the difference between a bank's assets and its liabilities representing the net worth of the bank or its equity value to investors, would remain healthy and above minimum requirements. But given banks, as lenders, are so embedded within the financial system, wouldn't they need to be on board for any deliberate house price correction? David agrees a collaborative effort would be needed.
Yes, if you wanted to engineer that outcome, then, it would have to be a collaborative sort of effort because, you want a correction to be orderly. I mean, ironically, prices going up can be very disorderly, but prices going down needs to be, in a market like ours, or any market, needs to be orderly, really. And so, a gradual adjustment is one that's preferable from everyone's perspective because it's sort of become self-perpetuating, a sort of spiral downwards, prices start to fall, and so it becomes, for example, it becomes unattractive to build houses and therefore employment in the constructor sector goes down, which creates more unemployment and so on. So you can sort of see how you get a downward spiral, which is why sort of things can go up in a disorderly way, but things going down in a disorderly way creates that sort of chaos, which is why governments intervene as they did post-GFC and as they have post-COVID. Yeah, I mean, I think if the situation arose where it was a concerted drive to engineer an orderly decline in house prices, then I think, the argument would be to do things gradually. For example, raising interest rates gradually, not 3% in one go, but maybe 3% over a couple of years, something like that would have an impact. Tax changes and things like that, like what we've seen in the last year. I mean, all the ingredients in some ways are there for an orderly sort of change in house prices at the moment. Most of the factors that would cause house prices to fall are actually in place now, you could argue, apart from unemployment. So in some ways, we've got the ingredients in place for an orderly and gradual reduction in house prices, or certainly a cessation of the increases that we've seen.
So if the government decided to go ahead with pursuing a housing market correction, should it set a target? Arthur reckons it shouldn't make one public because things can change quickly. But he says the government should aim to at least reduce prices by 20% to 30%. So could a correction be controlled?
Yeah, that's a really good question. One wouldn't do this all in one go. It's very difficult to predict the extent of any reaction to, say, an interest rate rise and a tax change, etc. So one would do this gradually over time, start increasing interest rates, reducing the amount of liquidity in the economy through reversing the bond buying program, and just keep doing that until one felt comfortable that prices were now at a more affordable level.
Next, we need to look at whether it would be desirable to engineer a correction, and what would you be trying to achieve. Arthur thinks reversing wealth inequality would be desirable.
Well, New Zealand now faces this extraordinarily unequal wealth distribution that's been created over recent years as a result of the house price explosion. I'll give you an example. If a person had owned 4 houses, 5 years ago, at around the median value for a house, they've probably made $1 million without paying any tax on that $1 million in the space of 4 or 5 years. So we have this extraordinarily unequal wealth distribution now as a result of the policies that have been run in recent years. I think it's highly desirable to try and reverse some of that wealth inequality that's been generated, particularly since the Reserve Bank Act was changed. And the people who haven't benefited at all from the wealth, illusory wealth increase, of course, those people who don't own a house. Now, it turns out that something like 70% of European families own a house, less than 50% of Maori families own a house, and less than 40% of Pacifica families own a house. So what we've seen is this extraordinary change in wealth towards that has benefited European families and has been at the expense of Maori and Pacifica families, and of course of young people who don't yet own a house. So, I think what we've got to do is to start thinking about the people who have really missed out over the last 5 years, and that's our, Maori and Pacifica families and young people.
Of course, in a situation where house prices fall reasonably significantly, those who have bought most recently will be the hardest hit. Michael Riddell, a former economic and policy advisor at the Reserve Bank, has an idea for how these people could be compensated. He suggests the government compensates recent first home buyers who sell at a loss a portion of that loss. So really, there's a way to compensate recent first home buyers?
Yeah, there is. We've seen this in a whole bunch of areas over the years. When you want to do reform, there are entrenched interests, and those entrenched interests make it really hard. And sometimes you have to be prepared to offer compensation to sort of buy off some of the more sympathetic of the opponents. And that's what I've proposed in respect of houses. I don't think anyone needs to be too sympathetic to investor buyers. I mean, they've run a business, businesses go up, businesses go down, sometimes you go bust. But we can all have a lot of sympathy for young people who are starting out. They're at the stage in their life when they normally settle down and buy a home. And so what I've suggested is that maybe for that demographic of first home buyers, we could look at a partial compensation scheme. It's not about compensating them for all their losses. Apart from anything else, they don't need to. People who've borrowed in recent years probably haven't been able to borrow more than about 80% of the value of their home. So 20% fall in the price doesn't make that much difference to them. It may wipe out their equity, but it doesn't threaten to see them dispossessed from their home. And so what I've suggested is something like a scheme that says, well, perhaps once you get beyond the first 20 or 25%, then perhaps the government could offer a compensation scheme for those people who do sell their houses, compensating maybe 50 to 75% of the losses. Would it be expensive? Yeah, it would be quite expensive, but we've come through the last year and got used to spending an awful lot of money, notably on the wage subsidy, when there's a compelling public interest. And I think if there's any area in which there's a compelling public interest at the moment in New Zealand, it's breaking through those obstacles to getting house prices durably down again.
So you'd need a firm set of rules?
That's right. I mean, you'd have to have lots of administrative details, and that's what you need, in a matter of public servants if you're going to design the details of the rules. But the principle seems sound to me. Why do you only do it for people who sell? Well, if you buy a house and you live in it for the next 50 years, you're not really facing a particular loss. You're buying a house to live in. But if somebody has to move house because their job relocates from Wellington to Auckland in 5 years' time, then that inability to buy a new house would be a real problem. So you do want to probably compensate that group. And you want to err somewhat on the side of generosity, because the whole point of what's going on here is you're sort of trading off different interest groups. You want to help the people who can't afford to buy a house at the moment. And so part of what you've got to do is sort of bend over backwards and say, we're going to limit the losses for the more sympathetic classes who've bought in the last few years and who've often been told in the last few years, well, buy but now, because if you don't, prices may just move higher and you may miss out. These aren't people who are actually speculating in property prices. They're just wanting a home for themselves and their kids.
So an engineered market correction could see changes to the winners and losers in the housing market. Those who've owned property for a long time and those with plenty of equity in their home shouldn't be much impacted. But those who've bought recently would be, albeit Michael's compensation plan could help them out. And joining the winners could be those who've previously been unable to buy a home but now could. But leaving our fictional Aotearoa New Zealand and heading back to the real world, could this engineered house price correction actually happen? Political commentator and public relations consultant Ben Thomas says it probably remains political suicide for a government to call for house prices to fall.
Yeah, I think so. There's been some polling, I think it might have been a Herald poll, which showed that 2/3 of people thought that house prices should come down. I think it's worth taking that with a grain of salt. Richard Prebble always used to say that when you were out campaigning and you asked people what are the most important issues to you, they would say education, health, housing for the community. And then when you said, what do you think your neighbour thinks are the most important issues to him? And they'd say, probably tax, probably back pocket money, how much money they can get. And Prebble would say that, New Zealanders don't like to directly talk about what they actually want. They sort of commentate on what other people want as a way of talking about that. And I think I think it's the same with house prices. people say that they want house prices to come down, but what you find is that when house prices do falter a little, the government usually takes a hit in the polls, and when house prices are soaring, the government of the day is usually very safe.
Ben reckons what voters really want when it comes to housing is to be reassured.
Look, if you're being cynical, you'd say that what there's a real political demand for is reassuring words about housing.
Like what?
Well, for instance, I think you would look to the current government, which talks about, slowing the rate of increase, about using a suite of measures. And, the key government did this as well. It would announce housing affordability measures, which, if anything, probably just added fuel to the fire of house price inflation. Things like increases in subsidies for first home buyers. But that dampens down the criticism for a few months or until the next lot of statistics come out. And more importantly, I think it probably salves the consciences of those people who will tell pollsters that they're really concerned about housing, but actually are sitting quite pretty right now.
To sum up by answering our 4 questions, yes, it would be possible to engineer a housing market correction. For the greater good, there's a case to be made that doing so would be desirable. Care would need to be taken to keep a correction under control. Recent buyers would shift from being winners to potential losers, but they could be compensated. And at least some of those who can't buy now would have a chance to do so, becoming winners rather than losers. But is it going to happen? It doesn't seem like the political climate is quite ripe for it yet. In part, at least, this is because, anecdotally, property owners appear to vote in greater numbers than non-property owners. But let's give the last word to Arthur, who reckons our politicians are taking a short-term approach.
What I'm looking for is a politician who's thinking about the well-being of the next generation, and I don't see one.
I'm Gareth Vaughan at interest.co.nz. Thanks to Janae Tibshirani and David Chaston for helping with this podcast. And thanks for listening.